Right. Welcome to this 26th November Audit and Risk Subcommittee meeting. Thank you all for coming. I realise you had a choice of places to go today. Thank you for choosing us. Starting with apologies. No, I think we'll take an apology from Andrew Noon for lateness. Are you happy to move that? Seconded. Confirmation of the agenda, no additions that we know of. Conflict of interest, people are reminded that if they have a conflict, they should stand aside from decision making. No public forum today, since no request for any members of the public to address us. Confirmation of the minutes.
Happy to move.
Moved.
Second.
Kate, seconded. Kevin.
Aye.
All those in favour? Aye. Right. Matters for consideration. No matters for consideration. I haven't got a... Oh no, I'm saying...
There's no actions.
There's no actions from matters for consideration. No. Yes.
No.
Right. Safety and Wellbeing report, we were wanting to do that now, were we?
Well, I think we could do that first and then they can go and then, because Miles, this is probably going to take longer.
Yeah. The floor is yours.
This is Nicole and Rebecca.
Thank you. Yeah. I guess if the report and the dashboard have all been provided to you, so I was just going to assume that everyone's had a good look through that, and if there's any questions or comments, happy to take those.
Have people got questions about what we've been given here?
No, it all made sense to me. What dashboard?
Yes. Have you got anything, Andrew?
I was going to, always good to get the update and sort of see progress from last time, and I can certainly see that a couple of areas always getting focused on there. Contractors, external contractors, and hazardous substances as well. So I was just quite keen, because it is sort of always mentioned, and I see you are making progress in that space, just to understand what the magnitude of activity is in that space in terms of the external contractors. Do we have many, in terms of that magnitude, and same with the hazardous substance as well, in terms of what is the sort of the magnitude of that look like too?
Yeah, sure. I can speak to the hazardous substances first. So we do have some hazardous substances that are still used in our engineering and biosecurity areas. So that's largely herbicides that some of the engineering team used just to control some of the weeds and whatnot around the flood protection areas. It's not large amounts. We don't use any poisons or anything like that anymore. That's all sort of contracted out. So it really is mainly herbicides. However, in the scheme of things, it's all fairly small amounts. So we are working towards reducing those amounts even further, and we've got a strategy towards working towards elimination of all of our hazardous substances. We recently had an independent audit that was in August, and they've made some really good recommendations to us around just making sure that things are stored correctly, etc., making sure that there are risk assessments and things like that in place for all of the substances that we use. But we're working towards actually trying to eliminate those essentially, but there will be some work that contractors do need to do around pest control for plants and wallabies, for example, that do use poisons and herbicides. So that's always going to be, unfortunately, it's going to always be a little bit of that.
Again, 1:30.
I don't know what that was.
Yeah, that was just a test.
And is that elimination by outsourcing it so that it is no longer held?
So the elimination from ORC's perspective will be that in the longer term it would be contractors that would be using that, and that is mostly the case now, that work has become more contractors who are doing the operational work, and ORC is more in their regulatory capacity. But again, I guess for example, if we talk about wallaby control, for example, poisons are used, and there's not really another fantastic strategy around apart from shooting them. So that is always going to be, there's always going to be some element of chemicals being used or substances being used out there. On the contractor safety front, so we've just yesterday actually released new safety procedures around contractor management, and that went through our new policy review group, which was really great. We do have a large number of contractors, and we're also a contractor. You know, for example, we've got the MPI working on the Wellbeing Pines project and the Wellbeing project, and we are contractors to the MPI. So we've got tight safety controls that we need to then demonstrate to them, for example. And we have a lot of, large contractors, DOC being one, for example, for that project. It was several subcontractors. So there are a lot of contractors out there and a lot of consultants. And we're basically working towards improving our systems on making sure that all of those contractors are pre-approved from a safety point of view, which means checking all of their safety systems and approving them on our system, and also making sure that they are monitored on an ongoing basis so that safety is covered off on all of those operational meetings with the contractor, that we are making sure we're aware of any incidents that happen. And so there's a lot of work being done in that space to make sure that we've got greater oversight. And I'll be starting to report more on contractor incidents. I've actually split up that dashboard that you get. It's now not in this edition, but the next edition. I'm able to now break out the contractor incidents. So we'll probably see more of those. And that's probably not because there's more stuff going wrong out there. It's just that there's now greater oversight over what's happening out there.
And, thank you. And are you finished, Andrew?
Is that? Oh, okay.
Yep.
Thank you. And your question prompted me and reminded me that the discussion we had last time about bus drivers and that thing. And so when you report, will you report separately for bus transport services to, say, Pest Work, to maybe us as a contractor, or lump them all together?
I was going, there's not that many for now.
No.
So at this stage I was going to probably lump them all together. However, I could still easily break them up into the different contractors, definitely. Particularly for our big players and some of those big projects in public transport. Yeah.
For me, it's understanding the difference between both the bus operators in some ways, because one could be worse than the other, and because they are substantial contracts. And the other one is an incident, and somewhere I saw a photo of a bus not being able to get around a corner or something recently. Is that counted as a health and safety incident, or only as a?
It would be a near miss if there was a potential for someone to be harmed.
Yeah. Okay.
And it would be an incident if someone or something was harmed.
I'm delighted if we get that stuff, because I do think we have to be critical of the routes that we're sending people on. Not critical, but critical in our own minds that we are checking that sort of thing is suitable, because various reasons things can change. People can go and paint new lines on a road that then makes a route not safe for operators and users. So that's great, thank you.
The other thing also that is being considered with the health and safety side of things with GoBus and Richie's is our customer support services take reports separately on any complaints that come through on public transport from just customers out there, and so that sort of gets reviewed as well with health and safety, and I think that's really great, because sometimes it might be a safety concern and that can then be considered. So I think they're going above and beyond as well into trying to just investigate those issues.
Is it above and beyond, or is it our job?
It probably is our job. You're right.
Sorry. Kevin.
So under health and safety again, so this Wellbeing Pine stuff that we're doing, so who's actually from forestry is actually advising us on that we have in fact got people with the correct health and safety understanding with forestry? So
essentially, DOC are our main, I guess, subcontractor, and then DOC will then subcontract to Central Wellbeing Pine Tree Control and a few other contractors. So it's essentially up to those contractors to maintain their correct health and safety systems and make sure that they are all appropriately trained, etc. So part of the health and safety plan is ensuring that every contractor is operating safely and has the correct training, etc. So it's essentially up to all of those contractors in the chain.
So where are we checking that that's actually done? Because at the end of the day, if it's our contract, the liability will finish up with us, won't it?
With Sarah.
With me.
Yeah.
Yeah.
For my son.
And because we've only just, all of that, I know the work is being done, but all of the requirements that MPI put in place around the agreements, the health and safety plans, is because I think the funding has only just recently come in, all of that is now just being developed, the health and safety plan. So all of that will include, obviously, the relevant training, any, external auditing requirements of those forestry workers, etc.
Yeah. Okay, thank you.
A couple of questions. One, could you, when you're doing your report to us, produce as a sort of separate table of things that you say are currently happening and over what time, so as we can next time have it so it reappears and says, yes, they've happened now. For example, further reporting will occur, something continues to improve, whatever. So various parts of the report just say, we are doing such and such. So as we can just track them and you can say, that's now complete, we've done that, or that will move into like the bus incidents and things. That would be useful for me, just sort of in a table, tabular form. Second thing, how are we doing our best to save Sarah from being in the gun for people working from home because as soon as that becomes a work environment, people falling over their toddlers and whatever it is that they're doing at home.
Yeah, we've got a pretty comprehensive working from home sort of safety toolkit. So we've got guidelines in place that cover the physical hazards, that also cover the emotional sort of mental health hazards around, people potentially being isolated from not coming into the workplace. Security, making sure no one comes around to your house for a meeting, for example, that you might normally have, consultant attend the office. Don't bring them around to your house so they know where you live. So it's quite comprehensive around all of the different types of hazards you might find in a workplace. We have various tools and resources in place. So we've got safety checklists that staff need to go through. They also actually need to submit photos of their home workstation for their managers to approve that. We've got, flexible working arrangements that are an agreement between staff and their manager so that we know what days they're doing at home, what hours they're doing at home, so that we can monitor them and I guess have that separation between what's work and what's home life. So we've got a pretty comprehensive, and it's in line with best practice in terms of what's been put out there by WorkSafe. So we've got a pretty good...
That's comforting. Has anybody reported anything to you?
We had, I think, one which was from home, which was on the incident report, and it was someone that hit themselves in the head with a plug as they were pulling their plug out of their laptop cord.
Oh, it's in here somewhere, isn't it?
I think that was one at home, But apart from that, nothing else has been reported.
It might be worth at some stage just seeing if you can, I don't know whether you do a spot check or I don't know even quite how you do it, but it seems unlikely that nobody's ever having any incidents or that, it seems like the sort of thing that having done the initial setup, people are just going tick, tick, tick and doing what they need to do. And
I think we are having ongoing efforts to encourage people to report near misses and incidents, whether that be at home or out in the field or in the office, and that's an ongoing thing for us and it will continue to sort of be that way. I think initially when COVID hit there was a little bit of a lack of clarity around, do we still need to report things from home? And of course the answer is yes, of course you do, because the home is your workplace. So I think we've kind of gotten through that now, but it's just part of our communication that has to just be ongoing to remind people.
Yeah, because it's just going to grow, isn't it?
Yeah, it's no different, it's your workplace. Yeah.
And that's presumably also your driveway when you're driving your work car home and driving over the toddler that you tripped over earlier in the day. I think it's like journeys to and from the work are a little bit different. So again, this is probably getting a little bit too legalistic, but of course we just want people to be safe out there in their normal lives, because I'm just imagining
because people bring their whole selves to work.
That your outside driveway might well be a workplace and
possibly if you're about to pop out to a field job. Exactly. So yes, people do have a responsibility to make sure that the home environment is safe if they're using that home environment as a workplace, but also from our perspective we need to do what's reasonably practicable as an employer, I suppose, and to sort of go and maybe do an assessment of everyone's workplace would be probably a little bit not really, something that would be done typically. So,
we're just a big organisation and easy to sue. That's what I'm saying.
Yeah, exactly.
So we need to be doing everything we possibly can to save Sarah from finding herself named as somebody for doing something.
Yeah, and the package that we've got in place at the moment is in line, like I said, with WorkSafe. It's in line with Safe Work Australia, because I've obviously been in Australia for a while, so I still like to reflect back on what they're doing. So it's all in line with all of your sort of regulatory guidance out there. Yeah.
Excellent, thank you. Kate.
So I should ask this question as well. The staff wellbeing and good initiative over Mental Health Awareness Week. I don't think we've seen the actual policy at a governance level, and that's fine. But I'm just wondering if someone is concerned in that, what are the steps, or how does that get managed to ensure that they're in a safe place and everyone around them?
Are you talking sort of a mental health perspective?
Yes. I think the staff wellbeing was sort of pitched in that way because of the Mental Health Week.
Quite
Awareness
holistic.
Week.
Yeah, look, I mean, I think if a staff member is going through, let's just say, for example, a mental health issue or maybe some kind of personal health issue, then we always would encourage them to speak to their manager directly with those concerns to help point them in the right direction. And I guess, from our perspective as well, if anyone is having any kind of physical or mental health condition that's affecting their ability to work, we would support them on a return to work plan if that's needed, helping guide them into any kind of treatment that they might need. We've obviously got the employee assistance program as well. And the employee assistance program doesn't offer just psychological support, it actually offers lifestyle support, financial assistance. They're actually quite a holistic service. Mm-hmm. So it's about just, I guess, getting around that employee and helping link them into all the supports that are available. And we've got a few people on non-work related injuries at the moment that we're still providing support with return to work plans to help get them back on track, rather than allow them to sort of sit home by themselves for sort of 6 weeks while they recover from their mountain bike crash. We're happy with medical support and medical guidance to support them back to work to help their recovery. So, I think we've really got a lot of things in place to help people that might be going through a difficult mental or physical experience.
We talk about mental health openly all the time. I talk about it routinely, at least once a week, in my communications with staff. Main thing is, that we don't treat it with any kind of stigma. We don't, have any barriers, hopefully, to people being able to seek help and seek advice. They can go to their manager, they can come to me, they can go and see Rebecca or Nicole. And we do have people that ask for help, and we're very happy to work with them.
Thank you. Any further questions? Andrew.
Yep, I was just going to stress, just in the last paragraph, and just relating sort of to the COVID environment, and it's partly health and safety, but probably overlaps with other process, just the importance of staying vigilant in that space still. I just know a lot of organisations have gone back to BAU, but it's very much still sort of sitting there and can come back pretty quickly at any time. So just that, in terms of just stressing to maintain that vigilance over the awareness and the protocols that could be required straight away, and just sort of the ramp up required.
Absolutely, we've maintained some of the measures we put in place for COVID, and in fact we've made some of them permanent. We still have extra cleaning done during the day, surfaces, door handles, those sorts of things. We display our QR codes, of course. We've also made some changes to the way we deal with sharing food and those sorts of things. We also have had a significant debrief on what we did around COVID across staff, and that means that we're well prepared for next time with some good learnings. and I think we can stand up a continuity management team at any time. And so, yeah, I'm pretty confident that we have all of the protocols in place we need for level 1, but that it would take us very limited amounts of time to ramp that up to, you know, a higher alert level if necessary.
Okay, if we're all done.
Happy to move.
Moved Kate, seconded Kevin, that we accept this report. Thank you.
Thank you.
For coming in for the work you're doing on our behalf.
No worries.
Yes. Yeah.
Both microphones working. So if you want to, you can either.
Right.
Yeah, but you've got that there.
Yeah, and the laser pointer.
Yeah, and so that'll click through, or you can click through on the arrows.
Yep.
Either. Yep.
The laser pointer is there.
Yeah. Yep.
Yeah. Okay.
Yep.
Cool. Thank you.
Yep.
Nick, were you going to introduce us?
Yep. So this is Miles O'Connor from Bancorp. So as I said in the cover paper, we use Bancorp as our investment advisors. We've used them in the past for a few things. I think you did some work on the Treasury Management Policy and SIPO, assisted with the tender for the fund manager. Miles has done recently quite a number of applications to the Lgfa for various councils, and so I've been talking to him about our situation and that we'd consider joining the Lgfa and look at some debt funding, and thought it would be good for him to come down and give audit and risk in the first instance an overview of how that would work and how the Lgfa and the joining process works, because there is quite a process to go through. It does take a little bit of time, but
And a consultation process.
yeah, there's some hoops we've got to jump through. So that's why Miles is here to give you a presentation on that overview.
All right, and welcome.
Thank you. First question, how long would you like me to speak for? Because I've got quite a few slides, but I can cut some of them back if you like and not necessarily deal with it. So
I think we've got a fairly experienced lot of people around the table, so the shortened version might be the better version.
okay, well the ones that I was going to delete were at the end. That was more an economic presentation if you want to actually. So I think I'll forget that. So I'll go through it reasonably quickly, but please feel free to interrupt and ask questions along the way. I will take half an hour, I think. So hopefully not too much long. It might be 40 minutes, but I'll see how I go. So just very quickly, I work for Bancorp Treasury Services. We're a Treasury advisor. We advise corporate and institutional clients on Treasury, and for local government, it's our biggest sector that we advise on. We have about 120 retained clients in New Zealand. About 35 of those are local government entities. We're established in 1987, offices in Auckland, Christchurch, a subsidiary in Australia, and we are the largest Treasury advisor. For local government, the areas of focus are providing funding and ongoing interest rate risk management. So that's if you're a borrower, and also to a lesser extent on investment management. We manage a number of investment portfolios, we advise on them, and as Nick said, we've done work on your SIPO and investment policies, and also assisted with the management, with the selection of the new investment manager. What we are proposing to provide, or what we have proposed to do for Otago Regional Council is the following. So assistance with joining the Lgfa, and the process is detailed in some later slides. So we'll provide ongoing funding advice, which is principally the Lgfa, but it also does include bank debt if that is an option, although there is a slight requirement possibly to need bank debt Probably not for you though, because you've got the investment funds. That gets a wee bit technical. And once you've got the funding, then it's an ongoing process of advising on the most appropriate way to manage debt, and that's using the ratio of fixed to floating rate debt, what's appropriate in the current circumstances situation, and we're in a very unusual situation at the moment. The use of fixed rate debt and interest rate swaps to achieve the interest rate risk management objectives, in other words, how much fixed you should have, how much floating rate debt you should have, and the aim is to achieve an acceptable cost of funds and protect yourself against higher interest rates, but take advantage of lower rates.
Can I rudely ask you at what cost your services come?
$2,000 a month for the ongoing service.
Thank you.
Inherent in our service is proactive contact, quarterly meetings and quarterly reports. So what we really say is, the onus is on us to be proactive and contact you when things are happening and when you need to be aware of what's happening, and to provide proactive advice as to ongoing funding, because funding and interest rate risk management is an ongoing process. It's not just you do it once and you forget it. It's like an investment manager. You have to look at it on an ongoing basis. I think in relation to your fee, you can probably compare ours to what you pay JB Ware. Well, I know what it is, and it's probably it's about 20% of their fee, isn't it? Or less, 10%?
I think we're paying them around about $120,000 a year.
So we're $24,000 a year, so.
On top.
Of theirs?
Yes.
Oh, no, they're your fund manager for your investment
so
portfolio.
I'm just saying that it's an extra from our point of view.
Yeah. But they don't advise on funding and interest rate risk management. This is a totally different subject. They just manage the fixed and the equities in the fixed interest. So this is actually this is a new area for you. It's advising on raising debt and the ongoing management of that debt. I mentioned that, so I can skip that, what we've done for you in the past. The Lgfa, it's a council-controlled trading organisation established in 2011, I think after a job summit. It's had a major impact on council funding, and what it's done is a positive effect. It's significantly reduced the cost of funding for local authorities, and I'll show you something about that later on. Long-term credit rating, the same as the government, has about 70 council members, and it's raised about $13 billion of debt for the sector. The Lgfa has actually succeeded even beyond its own expectations in its initial statement of corporate intent, and that's just because of what it's able to deliver, and I'll mention some of those later on. You do have to meet certain covenants to be able to borrow from them, and the pricing that you get depends on whether or not you've got a credit rating. At the moment, the intention is not to get my advice and the intention is not to get a credit rating, because you need to have about 50 million of debt to justify the cost. That's about $50,000 a year, which you get from S&P or Fitch, and whether you're a guarantor or not. So whether you're proposing to join as a guarantor, and at the moment the intention is, and I'll explain that in a minute. First bullet point's a wee bit technical. You have to contribute 2.5% of what you borrow as capital. Now, there is a joint, this is probably a reasonably important point, there is a joint and several guarantee applies, where all borrowers will be liable in the default by any of the borrowers. But if you don't want to become a borrower, you're restricted to borrowing $20 million, and it does cost you more. It costs
Guarantor, you mean?
Being a non-guarantor costs you 10 basis points more. So guarantors get a 10 basis point saving. I've been through this with numerous councils. There are quite a number of safeguards. I mean, the Lgfa has liquidity, so access to funds of $1.3 billion at the moment. It has a standby facility from the DMO, which is the Debt Management Office, of $1.5 billion. Currently, they only have that facility operative of $0.6 billion. They've never had to use it. The reason why it's lower is they don't want to pay fees on the higher amount. And the guarantee, and it's important for you too, is it's in proportion to your ratepayer base. So for you, it's 0.37%. So if there was a $100 million default, your share of it would be $370,000. So it's certainly not, obviously that, it can't be equal amongst the councils, because you're going from Auckland Council down.
And with the government partially standing behind it.
Yeah.
Its chances of default are
Minimal.
Minimal.
I mean, if the Lgfa fails, then I think there's probably other things happening that you need, which are probably going to be more concerning than just the fact that the Lgfa has failed. The government's a 20% shareholder, and the other 80% is held by the shareholding councils. Very quickly through this, you can borrow anything from 1 month out to April 2037, any maturity of debt. The further out you go, the more it costs. You can borrow commercial paper, which goes out to 1 year. You can borrow a floating rate note, which goes out to 2037. But the margin on the floating rate note is set, but the base rate is the 90-day bank bill rate, so that can change in accordance with changes in the 90-day rate. And then you've got a fixed rate bond, which fixes and that can go out to 2037. That fixes the rate for the life of the bond. Now that's actually the cost of, if you're a guarantor, so non-credit rating, being a guarantor, what it will cost. So if you borrow just on short, is that working? Is that going?
I think it might not work. Oh, yeah, there it is down the bottom.
I mean, up here, if you borrow for 3 months, it costs you 0.54%. That's floating. If you have it floating for 5 years, at the moment, 0.95, although if you fix it, so that's on a floating rate basis, if you fix it at 0.84%. And the most expensive is out to April 37, which down here, 1.42 or 2.14 floating and fixed. So you can see that it's very, very cheap borrowing. Are there any questions on that? That's
It's so
cheaper than sending out the rate demand. Well, if you know what I mean.
Yeah.
It's in terms of political carnage.
Yeah. Now, this is just, I just constructed a potential portfolio for ORC. If you had a mix, and we don't go out past April 2037, it's a mixture of floating rate debt and fixed rate debt. The most expensive that you're paying is 1.04%, and just based on 20 million, which Nick said is a good indicative initial figure. Your all-up cost of borrowing is 0.83%. It's, if I said that if I told you 2 years ago that I could construct a borrowing portfolio for you at 0.83%, I mean, you'd look at me as if I was mad. I mean, these rates are just unprecedented. They have actually gone up since I did this because there's been a new pricing email out from the Lgfa. They might be. They've actually gone up quite a bit, and that's really because of COVID and the vaccine. So that's actually pushed interest rates up. The expectation that, that the vaccines are probably going to be more effective than they initially thought. But, I mean, it wouldn't be over 1% at the moment. Now, I think probably reasonably important, the advantages of joining the Lgfa were pricing. So if you've got a bank facility, it would be at least 1.35%. So based on 20 million, the savings will be no less than $100,000 a year. You have immediacy of funding because once you've actually signed up to the process of joining the Lgfa, you can obtain new funding with probably, well, some days we've done it on a 1 day notice. Other times, I mean, it might stretch out to 3 or 4 days. So you've got immediate access to funding out to 2000, any maturity from 1 month out to 2037, and you can get longer funding tenors. Now, bank facilities get prohibitively expensive beyond, well, compared to the Lgfa, I mean, beyond, say, 5 years. I mean, you wouldn't have a bank facility in the first place, but with the Lgfa, you can actually go out to 2037. So if there was some compelling reason that you wanted long-term funding because there might be some sort of long-term asset, then you can go out that far. You wouldn't get anything like that with bank funding. And you do have increased funding flexibility because you can nominate any term out to 2037. You don't have that flexibility with the bank.
I'll just ask with regards to that 17-year window, essentially. So if we were to trigger something in 12 months' time, that 17-year window would be the same, essentially, 2038, sorry.
It's 2037 at the moment because it's limited to the bonds that the Lgfa actually issues. So in behind that, while you can have any maturity, the Lgfa issues bonds. Those are all the ones that they issue there. But you can nominate any term, but the maximum term is limited to April 2037. It's not automatically going to go up to 2038 next year, no. They may decide that what they like to do is they like to replicate government bond issuance, New Zealand government bond issuance, because then investors can get a comparison between Lgfa debt and government debt, and they get a higher yield from the Lgfa. But they like to maintain that comparative basis with the government.
So they generally would have a mix of terms that share that risk, I suppose.
What, for themselves or for you?
For themselves.
Yeah. Yeah, so the reason actually why they went out, previously it was up until this year, it was 2033. They wanted to go out to 2037 just because of the funding problems that became apparent when COVID was at its height. And they did have a few problems, but it's a slightly long story. But the government, basically it was the government having this LSAP program, which is the large-scale asset purchase program, which included the ability to buy $3 billion of local Lgfa debt, which broke the logjam on that. But they just thought, just to increase decrease their risk, they thought, well, I'll issue debt out in 2037.
Would you imagine changing the amounts frequently, or?
That you borrow?
I mean, my imagination would be that we'd borrow a chunk often and for a purpose and on a table effectively. What would you imagine in the... this might... that's not based on anything Nick said. I'm just saying that's what I...
So that would... I mean, that's a profile that probably if you said I need 20 million now, that's what we would introduce initially. So you can see that there'll be ongoing maturities every year, April 20... So starting from February 20... If it was now February 21, out to April 27. So it spreads the maturities. But so you'll have ongoing funding requirements to fund those maturities. There may be that you increase your debt as well, so that will require funding on an ongoing or on an as required basis throughout the year. And then this gets a wee bit confusing, but you've got when you borrow, you've got two risks. One is your funding risk, and this is the maturity profile of your debt, and the other one is your interest rate risk, and that is the amount, as what I was saying earlier, about the amount of fixed rate debt and the amount of floating rate debt. Now we manage that, or monitor it and manage it on an ongoing basis, because what is appropriate now might not be appropriate in a year's time. I mean, if this vaccine is stunningly successful and the world comes out of COVID and the governments don't provide the monetary support and the fiscal support that they are, and interest rates going up, then we would say, well, you need additional fixed rate debt to protect yourself against the likelihood of rates rising. So I think in answer to the question, it's you have to monitor it on an ongoing basis and make adjustments accordingly, but with funding, that is according to A, your maturity profile, and B, your ongoing needs for funding. Is that?
Yes, it tells me what you do. Thank you.
Disadvantages of joining, if you presuming you are going to be a guaranteeing borrower, you do have that potential liability, but as I say, there's a whole waterfall effect of what happens beforehand. I mean, the Lgfa actually has because of the security arrangement, has access or has the ability to sell your property.
So the first call will be on the ratepayers of the defaulting council.
Yeah.
And so the chances of...
Oh, well, no, not necessarily. I mean, the Lgfa just might decide, it's up to them actually, but they've got 1.4 billion of liquidity that they've got at the moment. So they could use that. They could use their access to their... So no, it's not necessarily straight on the ratepayers, no.
So I should have said, yeah. So there is a default. It won't be a small amount of money. Apart from having funds or liquidity in itself, the borrowing council has other mechanisms to secure that funding anyway.
The borrowing count, because the security for the Lgfa debt, it's in a debenture trust deed,
Yeah.
and the debenture trust deed is an overarching security arrangement which has the ability to charge general and special rates, so they could impose a special rate if they needed to, and if ratepayers don't pay, then the Lgfa, or the council, therefore the Lgfa, because they have it over all of them, they can actually sell the property, and that ability to sell the property ranks ahead of a bank's if a bank has a mortgage over it.
Yeah.
There is a need to consult. You have to go through the special consultative process because of the very unlikely event that the borrower notes, which I mentioned earlier, can convert to equity. Do you want me to spend 1 minute on that, or shall I just skip it?
Skip it.
Right.
Thank you.
The initial setup process does involve quite a bit of administrative time due to the number of accession documents. There's about 8 of them that have to be signed, but you have to go through the documents. Initially, a law firm prepares them. You've probably got to allow about 4 months to do that. You need to amend the Treasury policies to incorporate the fact that you're going to have Lgfa lending, and we can do that. That's part of what we would actually do as part of our service. We would actually amend the Treasury policies to incorporate that. That can be approved by just a resolution in council. That's not a special consultative process. There are the initial setup costs, and that's about $30,000 in the first year, and then there's an ongoing cost of about $8,000 to remain a member of the Lgfa. That's the process that you have to go through. Do you want me to quickly run through that, or?
I think it's just administrative.
It's procedural.
Procedural.
There's a statement of proposal there, which would include the benefits of joining the Lgfa. We would do most of the work with that, because as I said, part of our service is actually assisting you with joining the Lgfa in the first step, and then managing the debt on an ongoing basis after that. I won't go through the covenants.
What counts as revenue?
Rates and other income, so it's all revenue.
Why I say that is if Port Otago gave us some money, is that as a dividend, that would be income?
It's revenue.
Dividends.
And NZTA grants would be revenue.
Yep.
So it's effectively everything that we receive, excluding what we draw down out of reserves.
Everything that comes into the building.
Yeah, so if you take the 77 million, our current annual budget, we've got revenue for a whole big chunk of that minus what we're funding out of reserves, and that's our revenue.
Again, this is the procedural bit. I mentioned the cost there. There's the initial one-off cost of $22,000, but then there's $8,000 in the first year, so it takes it up to the 30, and then there's $30,000 after that. And you need council resolutions to approve the documents, and also you have to have it at the end. You have to have a council resolution authorising the signing of the documents. This is the one bit that I say we can't do too much of the administrative work, because that has to rest at council level. We don't have the ability to review documents and sign documents, obviously. Is that okay? Now this was the economic commentary that I was going to give you, so shall I just skip through that? Or do you want me to tell you in 2 or 3 minutes what's happening with interest rates?
Yep.
At the moment, there's been quite a shift in the last month. These are the projections for the official cash rate. Now, if you look at that number there, 6th of October 21, 0.1%. What that's saying is that the markets are projecting a 40% chance that the OCR will go to 0 by October 2021. It's at 0.25 at the moment. At the very beginning of November, or late October, that figure was 100%. They were factoring in 100% probability that the OCR would be at 0 by October 21, and they were factoring in a 92% probability that it would be at minus 0.25 by October 21. Does that make sense? So the markets were 92% sure, or assigning a 92% probability that it would be at minus 0.25 by October 21. Now they're only assigning 40% probability that it will be at 0 by October 21. And the reason for that is that the Reserve Bank in November came out with a monetary policy statement, and it was a lot less definitive about the fact that interest rates would go negative. Back in August, they came out and they said, that they made it clear that it was very likely that the cash rate would go negative because of the ongoing fallout from COVID. But because of the pretty strong economic recovery we've had in the September quarter, and we won't get the GDP data for September until the end of just before Christmas, they have certainly watered back those expectations of a negative official cash rate. The other reason why, so that's short-term rates, and as I mentioned, the long-term rates have gone up. I won't go through, you don't want key economic indicators, do you? I think you can read that at your leisure. If you suffer from insomnia, then just start reading that. GDP, I'll just flick through to that one. And so that was the expectation for short-term rates, because people ask us, what are interest rates going to do? And within that question, there's another question. You're talking about short-term rates, which are governed by central bank policy, the Reserve Bank or the Federal Reserve in the US, and then long-term rates, which is other factors. It is partially influenced by what is happening with short-term rates, but also by long-term economic trends, expectations for inflation, expectations for growth. And that's the blue line is the US 10-year Treasury bond, and the red line is the New Zealand 10-year swap rate. And you can see that there's a very high degree of correlation all the way through. We had a disconnect here back in August, and that was when the Reserve Bank, our Reserve Bank was more adamant, or they were giving a stronger indication that the OCR would go negative. The US poured cold water on their, well, they were less definitive that they would require negative cash rates, the negative cash rate. So our rates went down slightly, stayed the same. US rates went up, and then you can see there's each line on that graph is a day, and you can see there's a gap there and there's a big spike there, and that's the day of the monetary policy statement when the Reserve Bank came out with what I said. And also rates have been pushed up, as I said earlier, by the COVID, by the vaccine. So that's the very quick economic summary. Now, I just thought just to have a slightly light-hearted look at interest rates. This is interest rates going back 5,000 years. The Bank of England governor did a survey back in 2014 of interest rates going back that far, and that's what he concluded. And that's what they were now. There was a spike up in 1977, which I think was an oil shock, and then we had them from 1985 onwards until the end of the GFC, when they started going back down again. It takes the predominant empire of the period. So at the very beginning, it's Babylonian times, and it goes through to the Byzantium era, the Dutch East India Company. But back here, at the very beginning, the first person to introduce interest rates was a man called Hammadi in the Babylonian Empire. I won't take too long on this. It'll be very quick, 1 minute. And he was the first one to set interest rates. And now this does precede, I hope I've got to be careful here, this does precede, Babylonian times precedes gender equality in the Me Too movement by a few thousand years. But it was if you were a borrower, and it was assumed the borrower would be a male, he could pledge his wife, his children, and his slaves as security. Now, in very unusual circumstances, he could pledge himself, i.e. the male, as security. But if he did, then that security could not extend beyond 3 years. So it just goes to show that even in Babylonian times, they were perceptive enough to realise that a male's usefulness didn't extend beyond 3 years. So I hope I haven't offended too many of the males in the room.
That's why there's a council term of 3 years, is it?
But I mean, okay, as I said, it's a slightly lighthearted look. Why I did it, I don't know. But just one thing is that where we are now, people say, these rates are unsustainable. Well, actually, if you go back, they're slightly lower than what we've been, but you can see that the peak that we had, back in the late 90s, that's an aberration. So where we are now is not unusual.
But that does tell you that if the people in charge at the moment are people who lived through that peak as grown-ups, then they've got a different perception. Things that you can say are unlikely if you suffered them.
Yeah.
So it depends a bit who was suffering them then as to whether they believe that it's quite realistic that they would do something again.
I think when I very first started my career, I saw the call rate go to 1,000% Monday, and now I've seen we have had negative interest rates in New Zealand and bond rates. So I think I've seen most of it, but I think it's fairly safe to say that since post the GFC, the world is in a lower growth, lower inflation, lower interest rate environment, and that has been accentuated by COVID. So we are going to have interest rates lower for a lot longer, but I totally take your point. I mean, I would never say never that we can't go back to there, but at the moment, the indications are that for quite a considerable period of time going forward that we're going to have low interest rates, because the world needs low interest rates now, because for no other reason, central banks have issued about
You're welcome to come to the table, Brian.
Thank you.
Central banks have issued, it's over $7 trillion of additional debt. It might actually even be 11 trillion, and for no other reason, they just cannot afford to have interest rates go up because it'll cost so much more in their debt servicing.
Too big to fail. Where have we heard
Well,
that
it is.
before?
Yeah, it is. So that wasn't bad, half an hour. Are there any questions?
So to borrow $20 million, we've got to come up, we've got a $500,000 up front. 2.5%.
What's 2.5% of 20 million? I haven't got my calculator. Have I got my calculator here? Yes, but you get that back. So that's not a one-off. That's not a payment that disappears. That's just your contribution to the Lgfa's capital. So because the Lgfa is a financial institution, it has minimum capital requirements, and so every time you borrow, that's going to increase the amount of total Lgfa debt. So you're contributing that as capital, just like banks need capital. The Lgfa needs capital because it's a financial institution.
So if we borrow $20 million, do we get 19? Do we get $19.5 million to use? Or,
yes.
Yeah.
But you get the 20 million back.
Yeah.
Right, yeah. That's good. That's good. Yeah.
Are you in a position to advise us about investments of the other lot of the current, what is it that we call the current money we've got? We invest?
The managed fund.
The managed fund. Yes, we do that. So we have been employed either in the name of Bancorp Treasury Services or one of our other clients, one of our other associated companies, Ericsson. Ericsson's, we actually we do advise in a sort of an oversight capacity on the performance of funds, and that's actually what we did for you. Twice, I think we provided we provided analysis of the performance of the managed fund, and it looks at the performance compared to benchmark. It looks at the asset allocation. It looks at the returns that you've got going forward, the projected returns going forward. So it's someone who's totally independent coming in and looking at it. There are a number of them. There are a number of companies who operate it.
I wasn't meaning in an overseer role.
As an alternative.
As an alternative.
We advise on we manage about $2 billion of fixed interest, and we have an arrangement with other investment advisors whereby We manage the fixed interest, and they manage the equity portions of the portfolio. We don't have any expertise in equities, other than what we know personally, investing personally, if we do. So we do, yes, we offer that capability of being the actual investment manager.
I'm just sort of thinking that we've got Port Otago and what they do, and they've got bigger than half of themselves now as a property portfolio. And we've got JB Ware's managing equities and fixed interests. And if we had you also being involved in what we were, it just seems that there's some sort of, is this something that needs to happen in 3 different ways? I'm just opening the question. I guess it's still in my head.
Okay.
So you might want to park it for later, but...
I mean, what I've been talking with you today is about managing debt.
Yeah. Yes,
On the other hand, we do offer for a number of councils and other, MAS, Medical Assurance Society, we manage their portfolio. One of the guys in Auckland, he tends to do most of that. We manage the investment portfolio. JB Ware actually manages the equity portfolio. So we manage the money market and fixed interest portfolio. Ware's manage the equities in the New Zealand property. So we do have that. We do have that ability in conjunction with someone else. It doesn't have to be Ware's. It could be just someone with an equity capability to do that. But we also offer the oversight role, and that might be our associated company, Ericsson's, where they provide an oversight of the actual performance of the investment manager.
it's just something we might want to look at some point, because I noticed that, somebody who's advising you on what to do with debt would want to be knowing also what you were doing the other side of the ledger, just like somebody who advises us on equities ought to know what's happening with our Port Otago property portfolio, because some of the equities are property. I'm just having a think about that for another day, perhaps.
Yeah.
Thank you. Andrew.
So certainly Lgfa, very attractive for a number of reasons. So just thinking about, just so we've sort of got it out there and we are thinking about it, what would another alternative be? So what would the other alternative be if we weren't going down that route but wanted to borrow, just so we've at least had the discussion?
2 options. As long as you established a debenture trust deed, you could issue bonds in your own name. So Otago Regional Council could, but the ability to issue bonds in your own name has actually been restricted more and more by investment managers, because they will only invest in local authorities who've got a credit rating that would cost you $50,000 to get one. There are 1 or 2 who do it, but I used to do this before the Lgfa, and we used to issue bonds in the name of individual local authorities, small ones, Grey District Council, ones like that.
DCC.
Sorry?
DCC.
Oh, your DCC has a credit rating. They've got a AA credit rating, so they've never had a problem issuing bonds in their own name, which yes, you're right.
But they do a variety of things themselves, because they've decided up until recently not to involve themselves.
Yeah. It was a matter of public record. We were the one who did the review of DCC's borrowing options, including joining the Lgfa. It was in the it was a matter of public record, so I'm not giving away any state secrets there. That's one. It's probably not a viable option at the moment, because you'd have a limited pool of investors. The other one is bank debt, which you would get, but as I said, it is, and there would be no problem getting it. But as I said, it's probably going to cost you $100,000 a year. So those are the 3 options that you've got.
And the term. So with bank debt, the rate and the term would be less.
So the rate would be higher and the term would be less. So you have less security of long-term funding.
Self-funding out through your own investments, so you could do that. But again, the same problem.
Self-funding through the existing investments. I'm
not putting it up there as an option, one that I want, but in theory.
In terms of what,
the interest
if you are
rates, the differential would still be the same. That you just talked about.
At the moment, you can borrow at 0.83%. I could construct a portfolio for you now at 0.83. Oh, it's probably higher now because rates have gone up. Say 1%. What's been the return on your investment portfolio, Nick?
1.2
It was in
or
here.
something.
Oh, I thought the last quarter was about 5% or something, wasn't it?
Yeah, it was 5%.
I thought it was coming
It is coming
down to be under 2.
It was 5% in the last report.
Yeah.
So is that 5% for the quarter or for the year?
That was the quarter. It was, yeah.
I mean, I was talking to a local authority yesterday, and I mean, they had a return for the June quarter, for the June year, and that included the worst of COVID of 8.1%. And they are already a borrower from the Lgfa, but I mean, they had a cost of funds of 1.75%. So they're borrowing at 1.75% and investing at 8.1.
Yeah, so that was, but that was the equities part, not because we have a fixed interest part. I'm just remembering the fixed interest part compared with the equities, compared with the total. Yeah.
Yeah. I mean, equities have had a stunning, recovery since COVID, but also interest rates have come down dramatically, so that's increased the value of the fixed interest portfolio as well. I mean, it's been stunning returns. I didn't think, going back 2 years, we continue to have the sort of returns that we've had, and I didn't think we'd have the recovery that we had after. But I'm not an equity specialist. But after March the 23rd was the day when equities bottomed out.
Would you like to guess about residential asset values then, William?
No. I'm actually not. I mean, people actually ask us, I'd like to know actually, because we're looking at moving properties or buying one at home. We're not actually allowed to advise on that anyway, because I'm not AFA qualified. So even if a client asks me, what should I do with my mortgage, or I'm going overseas on holiday, if you could, when should I change my currency, I'm not allowed to tell you, because we can only advise corporate and institutional clients. Actually, I mean, what do I think on the property? I mean, that's not actually asking me what should I do with my mortgage. I mean, it's been a huge topic lately, and I mean, we actually spent about 20 minutes on our Monday morning conference call the other day just talking about property prices. I mean, I'm stunned that they're moving up as much as they are, and Grant Robertson wrote to Adrian Orr the other day, just more or less indicating that he needs to do something about it, and Orr's response, I think, was, no, it's not my responsibility.
Yeah. And then his response,
the tax word, didn't he?
Yeah, on the radio was where we've got a target and we've got employment and
inflation.
And if you want to add in house prices, we're throwing one object at 3 targets. Can't do it. So put it in there if you want to, but you can't. And then he went on to say that if you want to throw house prices in there, then you can throw the unemployment one out the door for a start on.
Yeah, and it would mean that interest rates would have to go up, and it would mean that there'd be a big increase in borrowing costs. So those companies that are probably struggling because of COVID, and their borrowers, would be forced to pay more, and that might send them broke. I mean, my view is that if you need to do something about it, then you probably have to look at some of the investors. I mean, I was talking to someone yesterday, and he said he knows someone who has 20 properties in Ponsonby.
Well, everyone likes to think you should do something to somebody else, doesn't it? And whether you can do things like the loan-to-value ratio is not necessarily going to solve those problems.
Well, I mean,
because if they keep going up, then the equity they've got in the other properties gives them what they need for the next one anyway.
But the problem with the LVR is that, I mean, that penalises first home buyers if you increase the LVR.
Even if you increase it just for investors, though, you might not achieve much with it.
No.
Anyway, sorry, we got off topic a wee bit.
I think, so the hot topic that's out there often discussed is the joint and several liability, which I think we've covered reasonably.
They'll be protected.
Yeah. The split to the population percentage was interesting. So that's obviously quite an important part of it.
Your 0.37%.
Yeah, as well.
I think Dunedin, when we did the review for Dunedin, I think they were 2.7, I've got off the top of my head, 2.8% of the guarantee. So it's in proportion to your rating base.
Yeah.
If their rating base is Dunedin, more. Can we look at risks the other way? Something like the AF8, whatever it's called, the fault line rust to a target,
exactly.
and what that would then do to us. I mean, I'm just putting up as an example because in some ways
it's a very real example.
Yeah.
Yeah.
We go down this track. I mean, the thing is, it's whether we want to take on debt. This is still the cheapest way to take on debt. And the cheapest way of getting debt means that you can repay it quicker or ensure that you've got funds to do that. Well, so a catastrophe.
Yeah. So I would certainly see it as stepping into debt, and debt would probably always remain a mix of your portfolio. That's the way I would have assumed it continues. That it doesn't sort of. I mean, you could look to pay it down, and then or you could just continue with having debt. As part of your mix.
Yeah. So what do you want your debt for?
Well, that's the question.
Yeah. I mean, what do you actually?
Well, the question is.
I've assumed it's long-term plan investment. Is that what it's?
What I want the debt for is to manage my working capital.
Yeah.
Because at the moment, as I've showed through the reserves analysis, what you've got is we've got all these reserves, but you've got to ultimately tie your reserves, particularly the general reserve, back to what you've got in cash.
Yeah.
Yeah. And what we've got in cash, then we've already got a portion parked in the managed fund, which sort of loosely equates to the amount of our dedicated reserves. And the rest of it, we get topped up this time of the year, and then we spend it on the remainder of the year. But unfortunately, we haven't got enough there to get us through the whole year because we've done the internal borrowing and lent out, over $20 million. So I don't have it.
Yeah.
So if I turn that into external debt, then I still have the money that I should have to pay the bills.
Yeah.
Because we literally got down to having, apart from the managed fund, having no cash in the bank before the rates money started coming in. And by next year, that will just come forward even further, and we won't have enough money unless I withdraw whatever we need.
So does that
make the managed fund?
Because I saw in the managed fund report there was a withdrawal of $1 million.
That's right.
And is that to do with the cash flow?
Well, that helped. We'd looked at what the cash flow was going to be and estimated that we should be able to get through to the rates coming in. And we withdrew that because traditionally or historically we haven't been withdrawing any money out of the managed fund. So the income portion that we've been earning has just been recapitalised into the managed fund. So we should be withdrawing an amount every year, and whether we do that 12 or 6 monthly, but we should have a withdrawal amount. So took that out and at the same time had an overdraft facility in place. So if we just didn't quite get there, we'd be okay to go into overdraft for, a period of a month or two if needed, but we didn't need to do that.
So,
No.
Just so back to the 20 million, is that needed because of timing differences between when the income's coming in and what we're spending it on, or is it because there's a difference in our income to expenditure? Well,
there's a difference in the income to expenditure, but what we've got, the reserves that are in deficit are the targeted rate scheme reserves. We have funded various levels of investment up front, and we are rating over a longer period of time. So effectively, you would like to think that a lot of that investment was all capital related, but a lot of it is, for example, in transport, setting up the Queenstown network, that cost us a chunk up front. So rather than just adding that in one lump sum to the ratepayer, we funded that up front, and then we're gradually building the targeted rate up. And the other schemes, the flood and drainage schemes are working that way as well. So we've got the bus schemes and the Leith and the Tyree and Clutha flood schemes owe over $20 million, and they're not going to repay that, in the next year or two. It's going to take a number of years. So if that was external, at the moment, then we get that cash back to put back into the pot to spend on other things.
Yeah, I see it being, in some respects, simpler to, in general, borrow if there's any, rather than borrowing from ourselves and rearranging our own finances, to when we're looking at a targeted rate, borrowing the money from the likes of Lgfa, and then so it's all in that jam jar's borrowed for that purpose, and it stays and pays it's there for the beginning, and then it pays off over a period of time with the targeted rate payers.
And I can't remember the exact figure, but let's say the lease 15 million, for instance, so that the current rating to pay that 15, the targeted rating to pay that back, what interest rate do you calculate that at? There's an interest rate component in there, so we could just simply borrow the equivalent of what's owed by the schemes.
And pay ourselves back,
And this interest rate,
if you know what I mean, and just say, we've actually borrowed it now at 0.083, we're going to change the rating, and that's what we're paying it back at. And then you still have your 23 million to play with. To suit your cash flows, if you know what I mean.
Externally fund your capex.
Yeah, externally fund the capex, which to me seems to be, and then you isolate it to that, and then you've still got your reserves to work with what you're doing. Does that fit with your thoughts?
That's what I'm basically contemplating doing.
Yeah. To me, that sounds spot on, really.
So, using that as an example, say the Leith scheme, at 15, that's spent.
Let's say 15.
15. Is that it, or is there going to be more spent? So is there going to be continued spending in that scheme?
Well, there's continued operating spend. There is still amenities to do, but that was going to be funded out of the Dunedin River Management. So there would be, though it falls into that scheme, it would be funded via there because it's not flood protection as such. It's amenity. So that was the plan for that.
But you could bang that into one lump sum, couldn't you? And fund both projects. But the existing one plus the amenity one under a borrowing of say $20 million and fund it back.
And it can be maintenance or capital, and the principle's sort of the same, isn't it? If you said that over the next 30 years that there's $20 million that scheme will need in the way of maintenance, 15 million for capital items, the rest of it for maintenance over that period of time, and just table it to the end of that and then borrow some more if you want to do more. And that operations and, maintenance and capital.
Are these discussions how, just in terms of, it's quite an important one in terms of how those mechanics work between the schemes and how to fund them, is that a finance committee discussion? Is that what's happening there? And just wondering where that gets looked at, oversight of
long-term plan,
Finance.
Yeah, we're just sort of
so we're
thinking about it in different places at the moment.
Just out because it is such an important,
it's
one that you need to sleep on for
it'll get there. It'll get there, having started growing its little kernel here.
Yeah, okay.
I think.
And it gets dealt with. The LTP, it falls into the financial strategy. The financial strategy will outline how we're going to fund everything and whether we should use debt and how we should use it. Yeah. And we'll that's where it'll flow through.
And if we're doing a major consultation, since we need to consult if we want to join the scheme, it's good to do that as part of the same. So have that in your mind while you're in Nick's mind, as it turns out.
And the next question is, if you were going to do that to that efficiency, would you do it for other efficiencies, which may be making more even the rates and things like that?
It's a different other thing.
Yeah. Can I the 0.37, which I think is the 5% guaranteed proportional ratepay base for the ORC. Can that change if the population shifts substantially?
Yeah, it's updated all the time, actually, but it's not going to change dramatically.
It's a proportion of the whole scheme, presumably.
Yes.
It would be. So as the scheme, if it had twice as many population in the scheme, then your proportion of it would be lower?
The proportion stays in accordance with your rating base, so that's basically according to your population.
Yeah.
So because Auckland has had such huge population growth, their percentage of the guarantee will have gone up.
Yeah. Yeah, it's a bit like the electoral system. There's no way ours can ever go up.
It's the only way that your percentage is going to go up.
Yeah.
We don't know, what the likelihood of any default would actually be.
Yeah.
Well, it's very low. But look, if there's a concern about it, we've got information. I mean, I've written letters and I've written. I've got PowerPoint presentations. The Lgfa have got them about the joint and several guarantee. I mean, I realise that it's quite important because
I don't think any of us are actually concerned, are we? Kevin, Andrew? No. Kevin?
No.
So I don't think that's a.
Yeah.
So associated companies you mentioned before. So is Bay Corp part of the associated companies?
Bay Corp, no. We're Bancorp, no. We've got nothing.
No, similar name. Debt collection, I thought you might.
No, we've got nothing to do with them. Sometimes I've rung people up actually and they said, we don't owe any money. I said, no. So, no, nothing to do with. Actually,
you might have been able to collect some. I mean, don't.
I think actually the chairman of Bancorp was on the board of Bay Corp. But that was just a total coincidence.
They probably rang him one day thinking he was a different.
But and just to stress earlier, your role can be sort of that treasury advisor role over the managed investment fund.
We could.
So you can sort of be our independent set of eyes.
Yes. It could either be us or it could be. We have an affiliated company called Ericsson's who specifically do that.
Yep, that makes sense.
So we do have that ability, yes.
Would you also, following on from that, have the ability to advise us about our investment in Port Otago / Chalmers properties?
Yes, we would. That would be Bancorp Corporate Finance. So that's another of our associated companies owned by the same group. So that's exactly what they do. Nick actually asked me about that a wee while ago, but they just... was that last year, Nick, or the year before? But they couldn't actually do it only because they had so much work on that they just couldn't deliver it in the time frame that was available. But that's exactly what, I mean, they advise on, well, they're corporate finance, so they do advise on investment, divestment, mergers and acquisitions. So that's exactly what they do.
We got some advice on the whole, which is probably after that conversation, about whether we should divest or whatever with Port Otago.
Bancorp was invited to participate in that RFP, but as Miles said, they decided not to due to other work commitments.
Yeah, but that was sort of, in some respects, a different thing. Yes. Do you want to keep Port Otago, in brackets, with Chalmers Properties? It wasn't the question of, say, if I was in your position of doing something with money, would I keep X amount in managed funds, have Chalmers Properties expose us to X amount of property, borrow X amount, that overarching.
Yeah, that would be a job.
What would you do with your whole?
That would be a job for Bancorp Corporate Finance. Now, we do work in conjunction with them. We're just doing something right at the moment where some of the work does cross over.
Because that's sort of a different question about whether you'd hold on to the port or not.
Well, that would be a bit what we call BCF, Bancorp Corporate Finance role.
Right. Okay, ladies and gentlemen, any other queries? No?
Really interesting.
Yeah. Thank you. Really helpful.
No, pleasure. Thank you.
So,
yes. Yes, I will move. Who would like to set it?
I was just going to ask Nick a question. Can I do that? Oh, do you want
do you want to do that before?
Yeah.
Well, while we've still got you in the room, Miles.
Yeah. What was that?
Oh, I was just going to ask Nick, what do you see as the next steps then of if we're of a mind to push this a wee bit further, which I get a feeling we probably are. What are you going to bring? Are you bringing something back to us?
It'll come back through LTP discussions, financial strategy, and we'll have a look and yeah, we'll have to look at how that flows through there, and then what the process is to actually get things moving through the consultation process, because the whole process from where to go can take sort of 6 months, can't it?
I mean, we've just done, I mean, I've done, I don't know, 15 of them. I've just done Waitaki. And I mean, I think we started that in May and we just borrowed this month for the first time. So it can be up to 6 months.
Well, you've run out of territorial authorities to advise, because Invercargill and DCC were the last two, I think, holding out.
Invercargill are a client, so we took them through that process.
Yes, so I'm saying they did, and then DCC as a reluctant starter.
Yeah.
So that you must be moving off from territorial authorities by now.
We can, I think we have about 35 around the country, but on an ongoing basis, we can drive from Blenheim to Invercargill, and every town or city we pass through, we advise the local authority apart from Selwyn. That's the only one. So, and I'm actually working on that one at the moment. But we're not where people say, oh, you should know about local government amalgamation. There should be more amalgamation. We just say no. We're totally opposed to it, because we could lose two clients. And if say Gore and Clutha merged, then we'd have one client instead of two.
Well, you might lose them both though.
Or no, it could become one. We think there should be more. We think there should be more local government. Actually, someone asked me about the amount. Like one of our children actually asked about how much local council spend on consultants. We said it's not enough.
Do they come to Otago?
Did they?
Yeah.
Oh, he used to be the eldest used to be a student here. Yeah.
Oh, that's all right then. Because I mean, that's the only university you don't want to merge the universities for the same sort of reason from our point of view.
No, you don't. But it is our biggest sector is local authorities. That we have more clients in local government sector than any other sector. That's what I do probably 2/3 of my time, 3/4 of my time with.
On the basis of what Kevin's just asked, and by the sound of it, it's a 6 month lead in time. I mean, the perfect scenario is if we go down this track that it lands somewhere July, August, September. That's the critical time, obviously, when prior to the lump of rates that come in October, November.
Yeah, although to be fair, if we're lining it up with the LTP, haven't redone the cash flow, but like I said, this year we were down to very little there in September, and it'll come back a few months this year. So the cash will run out probably June, July. So we'll have to have a look. But if we're still going through the process, we can still do some short-term bank funding through an OD just to bridge us until we get this in place.
Looking at that time frame, I'd like to see you kick the process off in late January.
Nick, I see that these recommendations, which I was about to move, but and I can see why it is all part of the LTP, but does that mean that you'd see it going back through council and the LTP rather than through finance? Because I would sort of like to see finance have eyes on it too.
Yeah, I mean, one of the things, whether it's finance or council, it's the same 12 people.
Yes.
In the first instance, wanted to have, obviously, the discussion here around audit and risk to get the feel for if everybody was, there was an allergic reaction to it here, seeing a bit more detail would sort of go, oh, well, we're going to have to look at something else. But now, assuming there's not,
this morning.
then it's it is a bit of really exactly where it goes would depend on the timing of the meetings, and it might have to go direct to council. In a perfect world, though, it would sit under finance.
Yes.
but, you know, we might have to go direct to council just because that expedites, there's more meetings, and then you don't have to worry about the recommendation then flowing on to council before it's official and you can act on it.
If we do that, we might have a think about where it moves next, and to make sure that Andrew's involved in because he's might have thoughts to feed back into that too.
Yeah, I mean, the thing is, if there is going to be work to keep things moving, council can delegate to, a group of councillors to actually work through that and do that.
So it could delegate itself back through Audit and Risk to pursue the opportunity, for want of a better word. Is that cool?
Yeah, I think the discussion we're having earlier was a very important one, and there's a few different options in there that can need to be sort of evaluated.
Yeah, and actually if we put it out in the LTP for consideration, that isn't committing us to anything, it's putting it out for consultation, and there'll be other workings through where we will go with that anyway. Kate?
Deb, probably a straw man I'm putting up, but I just want to be clear, we've got a hell of a lot to consult on the long-term plan. This is actually about saving money, potentially, because we could actually make more money investing and borrow at a cheaper and be a much more transparent funding system. Is it a discussion that should be happened? And I don't think as separate from long-term plan, preferably slightly before, because it gives us solutions to our. I'm just testing it because it is a separate one, and it will. What will happen is if whatever we choose will be a rates rise, it's going to be a rates rise. It is going to be seen as something different or an excuse, or rather than being a very sensible decision on its own right.
I would see there's two parts to it. One is the LTP is always going to have consultation included in it on the financial strategy, which is that document. This here needs consultation on whether we join, and there's some, whether we have to consult on being able to invest in the Lgfa through the borrower notes. So I could see that will be a separate consultation, because I wouldn't want to get that confused with everything going on.
That's fine.
But it might be running in parallel or slightly overlapping, but it's a separate. I do see that as separate to the LTP and financial strategy consultation.
And that's good, because I think we could get into a really murky.
You can.
And confuse the Jorahs out of everybody.
Oh, and that's why I'd actually like to keep this one separate, and probably beforehand, because I think we're going to interesting debates in the other one.
Is that, having heard what you've heard, Nick, is us moving the recommendation you've made still the most appropriate thing for us to do right now?
What was the recommendation?
It was to receive this report and the presentation from Bancorp, and that we note that the use of external borrowing via the Lgfa will be considered further as part of the LTP 2131, which is what's got Kate going. In conjunction with, perhaps we could change that resolution
or just put after the 31 discussions, because we're going to have discussions on that long-term plan. Yeah.
That's fine. Yeah. Just you want to change it? Yeah, that's either's fine. Yeah.
Considered by council further.
Take out the LTP part.
Well, I was going to say, will be.
Well, the financial strategy needs to be considered as part of the LTP anyway, and that might signal that this would be an option.
As part of the LTP discussions, as opposed to consultation, because we're going to consult separately, aren't we?
Yeah. I think it's a discussion amongst the council that we're going to raise.
Part of the LTP discussions, then, will we?
Yeah.
That's all right. Okay, I move that.
Yep.
Kevin seconds it. All those in favour?
Aye.
Aye.
Thanks, Miles.
Right, thank you.
Yeah,
Thank you. Pleasure.
Much appreciated.
Thanks.
I hope you had other things to do in town, but it was worthwhile for our opinion, so thank you.
No, I know we I flew down yesterday, one of our guys came down from Auckland, then we had to go down to Balclutha, then we had to go up to Oamaru, and we had a meeting in Oamaru this morning. I've just had a meeting at Dunedin City Council, came here, and I've got to go back to DCC and then fly home to Christchurch tonight. I haven't had lunch yet. I think I had breakfast.
I've eaten a biscuit. I'd have given you half my biscuit.
Eating in front of people like Andrew and Miles that haven't eaten is really cool.
Thank you.
Thursday, it must be Dunedin.
Yeah, cheers. Thank you.
I'm glad to hear Balclutha are looking at spending some money. That's good.
All right. Hey, thank you.
Yeah, thanks,
Thank
Miles.
Right, I'd
Put on Thursday.
like to now move a resolution to exclude the public on the grounds in the
Grounds that we don't want them to listen.
on the grounds in the paper.
Second, who's that?
I'll also move.
Oh, you can move and then Kate can second it then. All those in favour?
Aye.
Aye.